Welcome to The Savvy Entrepreneur. I'm your host, Doris Nagel, and I'm a crazy entrepreneur myself, and I love helping other entrepreneurs. I've counseled lots of different startups and small businesses as part of my law and consulting practice, and I've also helped or started at least 9 different startups, and I wish I could say they have all been madly successful, but that wouldn't be true. So I've made money, I've lost money, and I've made plenty of mistakes along the way. My passion is to share what I've learned and to find other experts to help entrepreneurs also get their advice and insight. So I welcome your comments, suggestions. If you have a topic you'd like to hear about or are struggling with a particular issue, you want to be a guest, or you know somebody who'd be a great guest, contact me at dnagel@lakesradio.org. The show will be better for your input. I would like to introduce our guest for today. Our topic is business valuation, and while that might not sound terribly sexy, it's pretty darn important. With me today to talk about that is Heather Grove, the Managing Director of Caliper Advisors, where she focuses on measuring, enhancing, and monetizing the value of privately held companies. She has over 15 years experience conducting valuation analyses of businesses and various types of stock and partnership interests for all sorts of reasons: mergers, divestitures, acquisitions, and the like, even gift tax planning, something you might not think about. Prior to joining Caliper Advisors, she was Director of Corporate Finance for a venture-backed technology company. She began her career as an analyst in the Valuation Services Group at Ibbotson Associates. Caliper Advisors is a leading independent provider of expert valuation and economic consulting services. I'm not sure what that is, but I'm sure we'll find out very shortly. And their clients are all over the map in terms of size, from startups to multi-billion-dollar publicly traded corporations. So with that, Heather, thanks so much for being on the show today. Welcome to The Savvy Entrepreneur.
Thank you. Thank you for having me.
Let's start out by just talking about what we mean by valuation. It's one of those topics, like I said, that I think when I mention it, most business people, certainly entrepreneurs, their eyes kind of glaze over, like, ooh, I don't know about that. What do you mean when you talk about business valuation?
Well, these businesses are privately held, right? So it's not like a stock that's traded on the NASDAQ or the NYSE where you can just go and sell it on an open market.
Right.
So you have to figure out how to peg a value to it. What's the company worth? What's the value of their interest? And it could be the value of the stock, it could be a debt instrument, it could be intellectual property. So anything that kind of creates value for the owner.
Yeah, that is a tough thing. You and I were talking in the lobby before the show about particularly startups. Very difficult to figure out what the value is. And I worked not too long ago with a startup, and the owner was convinced the valuation was $20 million. And he was trying to raise money based on that. I don't know, was it worth $20 million? External people, some of the investors that he talked to didn't seem to think so. So,
right.
So how do you figure out what a business is worth?
Well, in something like that too, right? We have all the theory on how we figure out what a company is worth, especially a privately held company. So there's a couple key things that you look at, right? Cash flow is obviously key. So we'd look at historical earnings of a company to kind of get a sense for what does the future look like by looking at that and looking at the industry and expectations, et cetera, how they've forecasted before in relation to what they're projecting. You also look at, it's kind of like comps in real estate. You'd look at other businesses in the same industry. What did they sell for in relation to their revenue, in relation to their cash flow, and hope to apply it to your subject company. Now that's tough because, again, they're private companies. You don't always have data. But
and if you ask the entrepreneur, they'll say their company is entirely unique, and there really aren't
they
any.
All are. They all are, and I hear it, a few times a week for sure. And I mean, one of the things I have to do kind of regularly is tell people that their baby's ugly. because they think, my company's worth 50 million. Well, it's not. But here's why. And then, here's why we came up with what we did. And now here are the things that you can do to increase the value. So while we look at cash flow, we also look at, private transactions. And then sometimes, and I'll say I hardly ever do this with my smaller privately held companies, but you would also, in theory, you'd also look at another form of the market approach, which is where we look at publicly traded companies and, how they trade in relation to their revenue and their cash flow. And it's tricky, right? Because they're so much bigger, more diversified, et cetera. But depending on the industry, sometimes if you're talking, software as a service or insurance brokerage or something, a little more uniform, you can kind of get a good guide, and at least it's a sanity check on the results of the valuation you used under, you did under other methods.
Wow, so that we've covered a lot of ground with that answer. So maybe we should take a couple steps back and unpeel a few pieces of all that, all those nuggets that you just shared. First, why would you ever want to have a valuation done of your company? It's not like most companies are, as you say, buying and selling shares of their company every day. So
right.
Why and when would you want to have a valuation?
That's a good question. So, and you do see this a lot of times, you have a family-owned business that's, passed through generations. They're not taking outside financing from a bank. They haven't really had any reason to have it valued. So then sometimes the first time that someone ever comes into value is when an owner passes away, or they want to do some gift tax planning. They want to gift shares to younger generation. Usually there's a trigger. Someone's getting divorced. You want to buy out a partner. You need to figure out what the company's worth for life insurance for the key men. You need to put a value to that. So those would be kind of some of the main triggers. Again, financing would be another one.
Yeah, so that's an interesting point you raised. I think a lot of entrepreneurs I've worked with think that they can just transfer shares for a penny. The
IRS would probably disagree.
It's like, who knows what the value is? So we'll just say it's a penny, and here you go. Here's 100 shares.
Right.
Is that?
Yeah, they could have some problems
that's
later.
A problem.
So that's that's something that it's a big reason why now we're getting a lot of calls, because now what's happening is you have this this demographic shift, right, with people retiring now, and looking to either they have to sell their businesses outside. We're seeing a lot more where the next generation is not necessarily interested in continuing on the business. And so now these owners have to look for outside buyers. So they have to kind of figure out, what it's worth before they put it on the market. But they also have to figure out what it's worth, to figure out how does their long-term retirement plan look? Like, what do they expect the proceeds to be? Get all their advisors involved, like the wealth managers, their accountant, et cetera, because it's not just the overall price of the business. How is it structured? What are you going to get after tax? Because it's one thing to say, I'm going to sell for 20 million. Right. You're not going to end up with 20 million in your pocket. Right. And then figuring out, what do I want to do after I sell the business? Do these proceeds give me, what I need to do, to accomplish my goals financially? Right. So that's...
Well, so I guess that's another way of saying, if you have an ongoing business, once you're past the very initial startup phase, trying to transfer shares for a penny might not be a very good idea.
No, that's a very bad idea.
Because the business has some value, and you have whatever number of shares you have. So whatever that value is divided by the number of shares is what you ought to be selling the shares for or transferring them for.
Correct.
Right?
Correct. There are things like discounts for lack of control and lack of marketability when you're talking about non-controlling, blocks of stock that apply. And it's beyond the scope of what we're talking about here. But
you're right. You're right. There's just so many different.
But you're talking potentially. You could have a pro rata value of a share of a controlling interest, in a company, and then when you're talking about discounting shares to the next generation, that could be discounted by 40%. So So that's a big deal. But that's also why if you want to take those kind of discounts, you have to go and get a proper valuation that's going to pass, IRS scrutiny, et cetera. So that's when you would do kind of a full-blown analysis.
Right, because if you're transferring shares, then there may be income tax or...
Yeah, there's potentially gift tax consequences, and so you need to kind of make sure that you button that up there. Now, if you're doing something where it's an owner that's, and I love to see this, they're ahead of it. They think, not just, I need to sell tomorrow or I want to sell next week. They are thinking, I have a 3-5 year plan where I want to sell the business. So now what do I need to do to get ready? What's my data point now? What is it worth today? And then you also figure out, what's it worth today? What are kind of the risks? What are the things that they should kind of tighten up in order to increase the value? And then where do they want it to be in 5 years? What do they need for their overall plan or desired exit, et cetera?
As you say, you love to see those kind of businesses, but I think the statistics, although this is not a discussion really about succession planning, we had Tom and Abby Caprell on the show a few weeks back talking about succession planning, and I know another colleague of both of ours, Barry Goodman, is going to come on the show in a couple of weeks to talk a little more about some of the aspects of succession planning. It's really shocking how few businesses really take that approach, and that's unfortunate because they leave a lot of money on the table.
Absolutely. I mean, I could tell you horror stories where even when an owner of a pretty substantial business has a great team of advisors, has the wealth manager involved, gets us involved, gets the accountant involved, et cetera, and then just drags their feet and doesn't do anything on figuring out what the succession plan is. And then what happens is they get sick, they get injured, or they pass away. Right. And then the widow is stuck with a business that is dramatically decreased in value and can't necessarily sell it, or has to sell it, in a fire sale.
Or gets involved in the business. I was talking at a networking event not too long ago about a body shop repair and paint place, and the owner suddenly passed away, and of course his shares went through inheritance to his wife, who then decided she should get involved in the business. And pretty much, I mean...
Can I guess what happened?
Yeah, it wasn't a good ending, unfortunately.
Yeah.
So.
Well, it's but again, good planning and being smart about it ahead of time makes all the difference. And even, we had an estate that we worked on where it was a family company, but one child was totally involved in it. The other two weren't. And this one even put money into it because it wasn't, doing as well, but wanted, dad's company to succeed. But when he passed away, he left the company in equal shares to each, where this is going, to each child. Well, then it turned into litigation. Yeah. No one speaks. It just, and there wasn't, the sad thing is the company wasn't doing well. It wasn't really, I had to go through and kind of prove to every sibling, this is really what it's worth. There's not a lot here, what you're going for, but it just destroyed their family. And all it just took was some good planning years before to avoid these kind of outcomes. But it's just unfortunate. And it, when you see somebody and they're not taking the steps, and then they're going to have a really bad outcome,
Well, so, valuation strikes me as kind of one subset of that. I mean, because you're talking about really facing the music. Mm-hmm. And I'm going to guess that most business owners have some idea in their head of what their business is worth. Now, whether that's an accurate idea or not,
right?
I'm going to guess most business people would say, well, my business is worth about whatever. And in their mind, they have some mm-hmm. assumptions, and maybe they've even, built a model, So what are some of the most common mistakes you see business owners make with their assumptions? They think it's worth $20 million, but your exercise says, no, it's worth $5 million. Because, business owners, most of us are optimistic by nature. We never do this crazy stuff, right?
Mm-hmm. one of the biggest things you see, and you see this with startups a lot too, is when they peg to a number or a pricing multiple that they see in the news that was based on a much larger entity or just a completely different entity. And so then they think that it applies to, to their company, which is much smaller or in a completely different or more risky, industry. It just doesn't add up. Yeah. A lot of times they have numbers, but they're not really based on, they understand how to operate their business intimately, but then how does that translate to value? Now, one of the most rewarding things that happens is that even when we value a company, it's for compliance. Say it's just for tax purposes. Yeah. And you're sitting across from a business owner and you're explaining to them how you came up with the value, and you see the light bulb go off where all of a sudden they realize, they understand what the value drivers are, and it helps shape their thinking. So if I change X, then I'm going to increase value this much. And they kind of make the connection then between operations and valuation. But there's a couple key things that I see people don't think about a lot. And they come up in almost every private company valuation that we do. So in smaller private companies, there are a few things. So one, you see a lot of situations where an owner is not taking any compensation, or they're taking distributions, but they're not paying themselves properly. So sometimes they're paying too much, but most of the time they're paying too little. And so the way you have to look at it is if I'm the buyer of this company, I have to come in, who would I have to employ to run it, to replace them, and what would I have to pay them in a market salary? And so if they're not paying themselves enough, you have to adjust the cash flow down for that.
So if they're only taking $50,000, but you would have to pay somebody $200,000 with benefits to run the company, then you have to build that into the cash flow model.
So sometimes they say, my earnings are $200,000. And so my company is 200,000 times a multiple. And you say, whoa, but you're not paying market salary. So your earnings, actually, if your salary was 250, you're actually losing money. Right? So it's actually not, so that's a big one.
That's good.
You're actually not making what you think you're going to make. Or what you should be making kind of normalized. So officer compensation is a big one. The other big one, and once you explain this next one to owners, they're more than happy to tell you every dollar that this, applies to. But a lot of things you see are personal expenses or non-operating expenses. So kids on the payroll who don't, who don't work, or a wife on the payroll, all kinds of vacations and stuff run through the business. And
so what's the funniest thing you've ever seen run through a business from
a pheasant farm in Arizona? Pheasant farm, yes. They had a pheasant farm in Arizona.
Yeah.
It's clearly a non-operating asset that but they said they had it, so that they could take people and entertain. So it was for business development. But
and the IRS thought that was okay, or
I don't know if we were involved in this. I think this was for an acquisition. So yeah, we were on the buyer side, and we came in and we looked at the books, and I was like, what's this? And they even had someone on the payroll that was responsible for managing the pheasant farm. So I'm like, we're gonna take that out of the equation.
Well, my funniest story is two horses in a large horse trailer. Because the owner's wife was very into horses and breeding horses and, as it happens, jumping horses. And so the horses somehow got on the payroll, as part of I guess they deducted the depreciation.
That's really funny.
With an expensive horse, but
I've seen all kinds of things, and so and this is one thing. You go through the financials of a smaller company, and they're not as clean. There's a lot of stuff in there. One of the big things you see with the smallest companies, they treat it just like, one and the same, like one pot with their personal assets. And it's like you have to treat it like a separate entity and clean and arm's length. So getting
so those personal loans to key employees to help them out, which is a wonderful
and
thing.
that's
that
you
small
know, and that's
business
okay.
people
They're on the
do.
books and they're documented. I mean, that's not so bad. It's running all your groceries through,
Ooh.
and you're all
giving
luxurious vacations.
our listeners great ideas.
Yeah, no, I mean, I've seen everything. So so you have compensation, right? So under market compensation, which will shift, kind of the measure that they're applying a multiple to. You have these personal expenses, and we could go on and on about that. But the other one that you see that we usually have to adjust for is sometimes you have a company and they will say the shareholders, and we see this a lot in family-owned businesses, right? So you have all the siblings, they own pieces of the company. Then they also own the facility that the company operates in a separate entity. And so they may or may not be paying market rent to this entity. And so sometimes they're paying a lot more to the entity, right? To that owns the real estate. And so I have to look at it as a buyer. Like if I came in, what would I have to pay an independent third party to lease this space? And so we would have to adjust that cash flow as well. So usually you see some kind of play that they're pulling too much money out of the company to push it into another family entity. Or sometimes they're not paying any rent. So you look at their financials. Why isn't there any rent? Well, we own it in another company. Well, I'm going to need to impute some rent expense. So if you had, going back to our example, if you had $200,000 in cash flow, but I figure out that your lease is actually, just say it's $300,000 a year, well, there's the difference.
Right. Now all of a sudden your business is not worth so very much.
Exactly.
Wow. Very, very, very interesting. So, when are the most common times that businesses would come to you for evaluation?
So a lot of times it's a trigger, right? Kind of like I said, you want to buy out a partner, you want to bring in new partners, right? As part of kind of your overall plan. Right. You're getting divorced, someone passes away, you're looking to gift shares to, next generation. God forbid litigation. Financing, you need outside financing. You're looking for investors, or you need bank financing. You need to document it that way.
That's a big one, isn't it?
Yeah, it is.
Yeah. And it's, it's interesting how, as we were talking about earlier again, how your understanding of what an objective, methodical evaluation of your businesses can really affect whether you get funding or not. And a company that I recently worked with, the owner was convinced it was worth $20 million, and unfortunately the investor groups that he talked to said maybe 3 to 5. Wow, that's a big disconnect, right?
That's a huge disconnect, and so not only will you not get the price you want, you may not get a deal at all. And I think in the situation you were talking about, they didn't get any funding.
They didn't.
So the big thing is when you're a startup, and especially if this is your first startup, right? You're not a serial where you've had multiple exits or even one successful exit before that you can kind of show. So when you're looking at a startup, you don't have prior experience, you don't have any traction yet, right? Because it's new. So you may have some revenue, but you probably aren't cash flow positive yet, right? And so all a potential investor has to look at is basically, the quality of the management team. I mean, it's the biggest thing. They have to feel comfortable. So then if they feel like the owner, the founder has unrealistic ideas about valuation expectations, it kind of says, well, this is kind of a sign of their overall thought process and their overall judgment. And this is basically the most we have to go on, because we have to trust that they're going to execute the plan and carry through. So it's really a bad problem.
It is a bad problem, and I think that the importance of a great management team is even more important than a lot of business people realize. One of our guests recently basically said that when they saw a great management team come to them, sometimes they would say, we don't like your idea, but we've got We have
Exactly.
some other great ideas. We think you are such a strong management team that we'd like you to take one of these other ideas and run with it.
Exactly.
And that just absolutely blows entrepreneurs away, because usually one of two things has happened. Either people come with an idea of some great new thing that if you build it, they will come, and that's how they've attached themselves to this idea.
Mm-hmm.
So to hear an experienced investor say, yeah, I don't know, you got a great team, but I think your idea is hogwash, it just kind of explodes their mind.
Yeah. It's the most important thing, and especially for a startup. But again, it doesn't matter if it's a startup, established company. It's all about risk and return. And the biggest risk in private companies is the management team. And a lot of times with the small companies, you have one guy. You have the owner, operator, who's responsible for everything. And while that's great, and we applaud the entrepreneurial effort, the key man risk there is so high. And so that's why another thing, when you're kind of looking to lessen the risk of your company, increase the value, you really have to make sure that it's not all hinged on one person. One person's not responsible for all the sales. If something happens to that person, the business can continue. It really, ideally, the business needs to be able to operate without the owner to maximize the value.
Yeah, that's an amazing observation that I hope business owners listening are really processing. I think the other lesson, that kind of the corollary of that, is to, when you're starting a business, think carefully about who you're starting it with.
Oh my goodness.
Because,
Yes.
the world is full of, your college ex-roommate or your cousin Joe. It's really easy to kind of fall into that, hey, let's get together, and that's a neat idea, but wow, it may have some really unintended consequences.
Oh,
right?
we could talk about this for hours. I spend a lot of my time on, shareholder buyouts.
Yeah.
And I used to think that, this only came up a lot when the economy was down and companies weren't doing well. And now we have companies that are, having their best year ever. And we have 50-50 shareholders are splitting up just because they have different visions, et cetera. So it's very important to make sure that, it's not just a handshake and everything's great in the beginning, right? We've documented this. We have a procedure for exit, et cetera. And it's just unfortunate.
I think the idea of allowing the business to run without you is one that's a foreign concept to a lot of owners. And connecting that back to valuation, that is one of the ways to really improve the value of your business. Talk a little bit more about that, and maybe some of the stories that you've experienced that work either to the good or to the bad.
Mm-hmm. So when you're just like valuing any asset, so it's all about risk and return. And so a huge risk factor for a privately held business is, owner dependence. And so while it's great that an owner has built this company and is responsible for the sales and the marketing, is the face of the business, it's also very risky, because if anything happens to this person, then, there's a detriment to the business. So,
but let's talk about that.
Yeah,
that's really a hard thing for some business people.
Oh,
right?
It's huge.
Because that maybe is the whole reason, the ego boost, or the day-to-day interactions and pressing the flesh with customers, maybe the whole reason they do this, right?
Right. No, and that's exactly right. And that'll get to something when we're talking about when they're actually ready to sell. There's kind of a psychological part of this, walking away, the difficulty there,
Yeah.
and some things I've seen with owners almost sabotaging their own deals because they start to freak out when they have to realize they're going to be stepping away from this. But when if I'm coming in to buy a company, and I look at their historical cash flows, and I'm thinking, okay, what do I expect to generate from this asset moving forward? I have to feel pretty comfortable, right, that those cash flows are actually going to be realized. And most of the time, you need the owner to stay on for, a few years to kind of transition, right? To
Right.
transition the customers, et cetera.
Right.
Because a big misconception that I get a lot. The owners think they're going to sell and basically hand over the keys and walk away on day one. And I see that all the time. And I have to tell them, no, it's not going to be that way. There's a transition period, and here's why. And you actually want to do that because
otherwise you lose the value.
Exactly. They'll cut it down so much, or maybe not even to do the deal if you're not a part of it. So you need to kind of transition. But it's just like anything else. If you're the only person responsible for something, and something happens, you've got to kind of diversify. It's just like in your portfolio, with your retirement portfolio, right? You're going to put everything in one stock. You're not going to do that, right? Because if anything happens to this one company,
right,
there's your retirement fund. And so you spread it out. And so it's the same thing kind of with the management team, sharing responsibilities, et cetera.
Yeah.
So a very key aspect. And I'd say when we're looking at private companies and you're looking at the risk factors that you would, discount a company for, that's probably one of the biggest ones.
Well, I think that's especially true in the service business. I actually was talking to someone a few years back about buying their business or buying into the business. And it was just one guy, and he had this neat consulting, he called it a franchise, but the problem is that he had never taken the time to put together all of the tools. Like he had, in his mind, this whole set of toolkits that he would pull with clients and, training sessions and train the trainer things, but he had never organized any of it. And I was like, well, this is fabulous stuff. He's like, well, look at all this great stuff I have. And I said, well, right, but I don't know this business. I don't know how to find clients in this business. You're the one, because he kept saying, well, I made a very nice income with this, and so my business, ought to be worth this. You ought to be willing to pay this. And I said, okay, but what's your involvement going to be? He's like, I want out. I'm done. Mm-hmm. I want out. So I'm thinking, I tried to explain to him. I said, look, here I am. I'm coming in. I don't know your business. I don't have the connections with your clients. I don't know inside your mind what this huge repository of various mm-hmm. tools and presentations and neat selling things that you do. So how in the world am I ever supposed to just step into your shoes without some kind of runway? And
right, and that would be difficult even if you knew the industry inside and out. You still, you need that transition.
Right.
With the clients. There's a lot to unpack there, right? Because there's a couple different things where, one of the things when you're talking about value is putting the processes in place and having documentation, having things tight, right? And if he had done that and was able to prove that, and then you could see how it translates into, revenue and cash flow, et cetera.
Absolutely.
There's value there. But absent that,
if
it's just in someone's head, and then it's risky. It's in one man's head. And if something happens to him or he's not around, then...
Well, and he even said, well, you can call me anytime. But the problem is that I found when I even was trying to call him to talk about questions I had, he was already off doing something else. He was, basically had no time. He had checked out.
Yeah. So you made a good decision, not...
I made a good decision, but, it made me sad because it was one of those opportunities where I saw up close and personal. We talk theoretically about how people leave money on the table, mm-hmm. but here's an example that I could see and touch where I looked at it and I thought, if this guy... if he just let me work with him for a year or two, we could put together the processes, map those out, map all the collateral, the different kinds of tools mm-hmm. and trainings and other kinds of intellectual property that he had, assessments and things like that. And we could turn it into almost a franchise where
Yeah, you saw the potential, but it just
where it wouldn't even I could then step into whatever part
Right.
that I wanted, but frankly, I could come up with, in my mind, I could see a process where I could franchise it and we could license it to other people, maybe in other different kinds of areas. And it would be an amazing revenue stream for this guy, you know, and he said, well, I don't really care about the money. And I thought, but how can you spent your whole life doing that.
Right.
How could you not want to leave the best legacy you can? But, you know, it was just interesting to see it up close and personal.
Right.
Because I think what you're saying is that a lot of business owners wait until they are really done, and then they think it's all going to be done. But
Right. No, it's getting better. You know, now if you're talking to business owners that are in their 30s and 40s, there's a different, you know, they kind of always want, even if they don't have a trigger, like they say, oh, you know, maybe I might want to sell in 5 years, or maybe I'm going to continue to operate. They still want the data point and want to understand where they are as far as valuation, you know, it's kind of a baseline, so then they can create value along the way. So it's kind of different. You know, before I used to see family-owned businesses that would just, you know, hold the company and transfer it to next generation, and it probably never valued the company. And then all of a sudden would go, all right, maybe we want to sell, or we have to sell. And God, when you get those calls and we have to sell now, you know, the owner's sick or something like that. And it's heartbreaking, because I look at it and go, we need 2 years to clean this company, you know, to clean this company up.
Right, much less maybe looking at ways to build the value of it.
Well, right. Well, that's it. And so instead they're on the downward slide.
Right.
You know, because maybe the owner's deteriorating and the business is suffering. And so it's bad for a number of reasons.
Yeah. So we've kind of talked about valuation conceptually and in the context of growing and managing your business in a sound way. Let's talk, maybe spend a few minutes talking about the mechanics of evaluation. Okay. It's not a very sexy topic, but well, for you it probably is. But you know, how long does a valuation typically take, and how much does it cost?
I could kind of go through just real quick kind of how we do it, what we do, and then depending, you know, it depends on the purpose too, right? If you're doing something, like for example, if you were looking to buy a company and you said, you know, this is the price that they're looking for, can you take a look and see if it's in the realm of reasonableness, right? So that's like kind of a quick calculation, a little bit of research, right, to kind of give you that data point,
right? Which
is very different than if you're saying, I have this company and I want to gift shares to a child, and it's going to need to survive IRS scrutiny, et cetera, right? Then that's more of so you have kind of a calculation on one side, and then you have the full-blown report that would survive IRS, SEC, you know, litigation, scrutiny. Right. So on the other hand, so you can kind of talk about that. So obviously the calculation is pretty easy, but no matter what, I mean, you're looking at, you know, so first you're gonna gather some data. You're gonna get the client's financial statements, tax returns, major contracts, so leases, supplier agreements, anything contractual, right, that kind of ties them into anything, either spending money or collecting money. So any customer contracts, a lot of times we don't see that, right? They're not contract related businesses. Yeah. You know, you'll do your general industry research, economic research, pull transactions on companies that are, you know, have sold in similar industries or the same industry, look at public comps, et cetera. So we typically do kind of a preliminary financial analysis, and then what we want to do is sit down with management and basically ask them about the things we saw in the financials. What happened with this expense? What are there any non-recurring or non-operating expenses? Are you running a pheasant farm through your business? Anything that
That's a classic.
do
I
you have
never
any
remember
kind of,
that one.
labor issues we need to talk about? What do so we talk about the history of the business and then their expectations for the future. We like to talk about projected cash flow.
Yeah.
A lot of times with private companies, they're not regularly, especially smaller ones, regularly preparing budgets and projections.
Right.
Right. It's rare that I see them. So you're kind of helping them, through that process. We're kind of trying to understand, if I'm coming in to buy this asset, what's the expected cash flow I expect to receive? And then after that, you can kind of come up with a preliminary kind of value indication. And again, you can come up with 100% for the, for the equity, depending on your purpose. If I'm looking to buy or sell this company, or, if you're looking to gift, or you have a shareholder buy-in or buyout, and you need to look at a minority interest, then we kind of go through the discount analysis and all that. Depending on the purpose, document in a report. So if you're talking a full-blown valuation, say we're doing for tax compliance purposes, it's a 3-4 week process probably, and it could be generally, and again, this is the big caveat, an operating entity, simple capital structure, no other sub entities,
Right.
other businesses we have to look at, pretty clean, is usually like an 8 to 10K thing, and then obviously if you do more limited scope, you kind of throttle back from that.
Yeah.
And then the calculation is just something we would typically do, on an hourly basis and advisory basis.
So, going back to a question I think we started to talk about earlier, what are the biggest factors that affect the valuation?
So,
And I suppose that depends on the industry, etc. But
well,
the
sort
big
of.
buckets-
There are some big buckets that will apply to every single company, because again, it's all about risk and return, just like every asset, right? So it boils down to, what are the key things? We look at, every aspect of the company's operations, right? And their management team, that's usually the big one in these companies.
Right.
Key man risk,
Right.
that's usually a big one. Sometimes we see customer concentration, where 70% of their sales come from Amazon. That's a problem, because if anything happens with the relationship with Amazon,
Right.
that's going to be detrimental to the business. So key man, customer concentration are two big ones that we see. I would say just general quality of, financial information, processes, et cetera. Meaning how buttoned down are they, generally speaking. If I'm looking at it from a buyer's perspective, and I come in and I ask for financial information, and they give it to me, and it's tight and it's clean,
Right.
as opposed to it takes them 4 weeks to get it to me, and then I get some, garbage that I can't decipher. As a potential buyer, I'm not feeling really good about their financials, and not feeling really good about the company, the company as a whole.
So it's interesting. I think a lot of people maybe think about getting a valuation done as this sort of a service, like, I'm going to have my tax return prepared by H&R Block. The way you describe it really, and maybe there are valuation companies that sort of approach it that way, but I think the way you're describing it, you're really a business consultant,
Absolutely.
because I'm envisioning that you have conversations. So let's take the management team, for example, and the fact that you want a strong management team. You need to then have conversations with the management and say, great if it's a fabulous team. You can say, hey, this is one of your real assets. You really, maybe you're not paying this guy or this woman that as much as you should. You might want to think about that, because those people are pretty critical for your business and they're real assets. But I'm sure equally there are difficult conversations, which is, cousin Frank is not really pulling his weight. Everybody knows it.
Right.
if you're going to sell this business, you're going to need to do something about this. Those are hard conversations.
Right. No, those are hard conversations. Getting back to something that you touched on, which I think is really key, and I'm so passionate about this. I think too often people think, valuation's just some, they have to get it for some trigger. Say that their bank says they have to get it, or they have to do it for tax purposes.
Right.
It's kind of like, oh, it's a pain. We got to pay $10,000 to do this.
Right.
And the mistake.
And can't I get one for $5?
Oh, or an online calculator for $250.
Right.
And no, not even the same thing at all. But I feel super passionate about this, and I know, and I've been told by people that I work with, attorneys that I work with, and bankers, etc., that there are competitors that do this. So basically, you just kind of produce it, and then the client just puts it in a drawer, files it with the return and puts it in a drawer. And that is a mistake, because even if you have to value this for compliance purposes, you have a treasure trove of information now. What are the risks in the business? What are the issues? Because we went through every single piece of it, and now learn from it, use it as a tool for the future. So you've had to go through the whole process. So they came back and said, wow, we're kind of dinging you a little bit because of your customer concentration. And then I've had clients who have done this and said, now we're going to fix it. And so then they come back a few years later and they need to value it for the bank again, or they need to value it for another purpose. And they've fixed that. And so then we can kind of reduce the risk premium that we add to that company, which therefore increases their value. So again, risk and return. So if you reduce the risk, one, you increase the chance of doing a deal, and you increase the price, because the lower the risk, the greater.
Right. So if you have a management team that's solid and is not dependent on one single person, less risk.
Exactly.
You have a nice big, a diverse group of customers that's not concentrated. You've mitigated risk.
But that's what it's about. So look at every factor that way. And so you have two companies, same revenue, same profitability, everything, but one has a really solid management team and one has one guy. All things being equal, right? The company with the more diversified management team is worth more. You have the same set of facts, and you have one has 80% of their business from Amazon and one has a diversified client base. Guess which company is worth more?
Yeah, it's interesting. That makes total business sense, and yet I think somehow a lot of people's minds are affected by these unicorns that you read about in the news.
Yes.
You gotta have some, real, disrupting kind of idea for it to be, and then it's worth a lot. Otherwise, not so much. And it's not. Those are probably really the exceptions.
They absolutely are.
For a reason.
They absolutely are. I love when someone sits down and it used to be we're the Uber for, the Uber for this. Yeah. And then that changed a little bit.
Well,
but
we're still losing money, so I don't know if that's so good.
No, right? Exactly. But I think the beautiful thing is, and I think, operators of private companies get this, but you look at these companies and I love the companies that we work with, but they're not sexy businesses. They're making some small part that, they sell to NASA and they sell, nothing sexy, or they're making, equipment for bridge building.
Yeah.
But these companies are fundamental to the growth of the economy. And kick out a ton of cash flow and employ a ton of people. And then there's the ripple effect, right, on the supply chain and all of that. So it's really a neat thing. And so the companies that you see, on TV or you read about in the Wall Street Journal.
Yeah, who wants to read about widgets, right? That's just.
But that's it. It's not sexy, but I think it's beautiful, and they're all just flying under the radar and building cool things. And and employing a lot of people and
yeah.
creating wealth for their families and then
Absolutely.
giving it back in the communities. And so,
Absolutely.
yeah, so.
Well, we didn't talk a lot about you. I mean, I gave you a quick introduction, but I'm curious, how did you get involved in this whole aspect of the business? What drew you to it?
Oh, into valuation?
Yeah.
It was a complete accident. So, going back, people think this is crazy, but when I was in 7th grade.
7th grade?
Yeah, 7th grade.
I don't even know what I was doing. I was picking my nose.
No,
or
7th
something.
grade, I wanted to be a corporate securities attorney. And I was
Oh
like,
my
that is what I'm going
goodness.
to do. Well, my cousin was a partner at a big law firm. And
I didn't know
just
I didn't
really-
know what a corporate securities lawyer was.
So this
I
is-
don't think I even knew when I was a senior in high school.
Well, I really loved law and I really loved finance. And then I had this great role model. And so everything that I did was built towards I was going to do some kind of business law. And so then, I majored in accounting and finance, and all with the idea that I was going to go to law school, but I was going to have this great financial background that was going to help me
brilliant
when I
plan.
practiced. And then I think I went to undergrad at Indiana.
Well,
And
I'm sorry to hear that.
right.
You seem like a very intelligent,
That's right.
person
I guess this
despite
interview's
that.
over now.
Right.
And so at one point I got to know my investments professor really well, and he suggested that, I had decided that I was going to take a few years off before I went to law school, make a little bit of money of my own. And so I was going to, interview for a job, and he suggested that I go speak with Ibbotson Associates, that he knew, Roger Ibbotson from University of Chicago, and had, I think he wrote a white paper with them, et cetera. And I went and interviewed there. Still had no idea what I would possibly be doing, because they talk to you about auditing, accounting, banking, et cetera, but no one talked about valuation, litigation support, et cetera.
Right.
And so, I started seeing Ibbotson pop up in all our textbooks, and I went to interview there. Somehow I got hired, and my first job basically was working with Roger Ibbotson on all of his securities litigation matters.
Wow.
And so, I got to pour through the other side's depositions, re-engineer their models, prepare, testimony, all this kind of stuff. And it was amazing. And I never knew it was a job before. And it was the perfect blend of finance and law.
Yeah.
And so then
Without having to go.
Yeah, and then I
law
never went to
school.
law school. And so then my whole career I started out doing all litigation, so valuation related litigation for several years, and then I really wanted to shift into the transaction side. And so that's kind of how that happened. And then so now, and especially because of the market the way it is, most of my practice now is focused on buying and selling companies, or navigating shareholder buy-ins and buyouts, like we discussed.
Fabulous. So what do you enjoy most about your job before we sign off here? Just about out of time.
Oh, I mean, I love my job, but I love working with entrepreneurs, business owners that are just, killing it every day and building. Again, they're not sexy businesses, but they're just working hard and building great businesses. I get to be, as opposed to when I started out, I was working with big public companies. I'm really hands-on. I get to advise on all aspects of the business. I get to help them with other people in my, in my network.
It's very
and
real.
So,
It's
I
not
mean,
theoretical
it's fun
at all.
It's
Yeah.
just, every single day is fun. I get to see how things are made, and just, again, work with really interesting people, in my network and the business owners. So,
And I'm sure watch them grow, which is really
it's super rewarding to be able to play even a small part in their success.
fantastic. Well, Heather, thank you so much
Thank you.
for being on the show today. It was really great having you on the Savvy Entrepreneur. Just a ton of wonderful tips and insights that I hope our listeners have really enjoyed. So that is our show for this week, folks. Thank you so much for listening. And again, thanks again, especially to our studio guest, Heather Grove from Caliber Advisors. You can find more helpful information and resources on my law website, which is forsythialaw.com, or my consulting site, globalocityservices.com. There's a library of blogs, tools, podcasts, and other resources there for businesses at all different stages. Finally, don't forget to email me with suggested topics, challenges, possible guests, or just to shoot the breeze. I'd love to hear from you. dnagel@lakesradio.org. Join us next Saturday. But until then, folks, happy entrepreneurs.